this is the distribution phase of a Wyckoff event, or it's a massive market, or it's a breakdown of market structure in waves or cycles. This can be interpreted into pretty much all sorts of time frames, high time frames and low time frames. In the smaller time frames, when you break it right down, you'll see these similar sorts of moves. They'll often overshoot and not really line up perfectly, but the general psychology or story behind it is still the same with the way it works. Now, something needed to mention at the first. So this is this is a typical price cycle, or when you're talking Elliott waves, this is more or less how an Elliott wave works. If I'll put on, pretty sure I can draw on my own screen. I'll try that. So if we're going to talk Elliott waves, the accumulation phase is sort of like your first leg of money on an Elliott wave, and then you got your impulse move, and then your distribution zone is like your final wave. Does that sort of make sense to people? Can everyone see the drawing on the screen where you've got your first wave? So that's a wave 1, wave 2 on the first retracement, your impulse move, and then you've got your second retracement, and then the fifth retracement. They sort of work out to be an accumulation phase, a markup or impulse move, and then a distribution phase. From there, it can go up again and again and again, and this can be a continuation pattern, and this would then essentially become one big move, and then you have a stronger retracement. So let's say, for example, this is your wave 1, 2, 3, 4, 5. Then you can sometimes have an ABC correction like this, right? And this then becomes wave 1, wave 2, and then you continue up for wave 3, and so on and so forth. Or sometimes that can just come right back and you have a fifth wave back down, and it does a full market reset. So that's just like a typical market cycle. As we know, the market doesn't move in a straight line. It zigzags up and down, and that's like your general cycle of a price movement. You have an accumulation phase, you have a markup, and a distribution. It's just simple. That's just how it always works. And Wyckoff is a slightly tweaked formula to show the different phases of that cycle and break down each individual, basically the accumulation phase and the distribution phase, and how you can determine those areas. So when you're in the accumulation phase, or if it's a distribution phase after an impulse, you can use what happens inside that trading range to determine where we might actually go, whether this is another accumulation and we're about to continue, or continue on that trend, or whether it's a distribution and we're about to reverse. So, they can be both the same thing. So this same pattern, if it was tested the right way and there was actually buyers in the market, then this would have been a continuation pattern. Okay. Now I will show you, so you can sort of see this pattern here and see how it works. I wish I could post the picture onto our chart, but you can't. But how would I do this? There's no way to bring it both up together. But currently this distribution phase or consolidation phase, which is what most people would call it, is playing out to a T to a typical Wyckoff pattern. And the way it works, the way that I've labeled them all in the exact same way that this is labeled here, so you can understand it, and I'll sort of run through each one to begin with. Now you can see on the visible range here, you can see that this is the majority of the liquidity here within this range here between, I'm going to say 10.6 or 10.5 and about 12,000. So that's technically our trading range. And you could probably drop that down a little bit, something like that. So that's our trading range. This is where all the liquidity is. So this is where the market's really moving, and these are overextensions or tests. Right, so we have this first impulse move here. So let's say the last phase where the market was consolidating was back down here, and then we've moved out. So let's just assume that there's big institutional money, market makers, whales, whatever you want to call them, big smart money that's been playing these sorts of games for a long time. They're in from down here long, and they're looking to offload. Now, when you have, we're not talking about 1 BTC, half a BTC, quarter of a BTC. We're talking about dudes that have thousands of BTC. When they're making a move like this, they need to offload. So they need volume to be able to sell into. Otherwise, they can't get the price they want. So if they want to sell at a specific price, they need to drive retail traders up to sell into them or sell their bags to them essentially. So the retail traders provide liquidity for institutional traders. It's essentially how it works. Institutional gets in and they're smart. They'll sit in here and accumulate longs. And then when they get up, they'll distribute their longs to the retail investors. So this first impulsive move here, or sorry, I should say almost second, but you can see where it went quite parabolic here on the 4-hour chart. This would have been the first sell-off. So you can see where we had a fairly decent halt in the market, and there was still a fair amount of volume in this area here. This was the first blow-off pattern, and this is called preliminary support. So this is, preliminary supply zone. So this is where the supply of Bitcoin was being sold. This is the first level that basically institutional investors would have seen massive increase in volume and gone, rightio, this is our time to offload. There's a massive increase in volume. If we're going to sell, this is where you sell because you can sell. So we saw a big sell-off there, a bit of a halt in the market, and then we continued up. We saw even more volume. You can see here the volume just increased something crazy, and that's where you get your blow-off way outside. So when you have that first sell-off, that generally kickstarts where you would have a distribution phase, and then the blow-off sets the top, okay? So that's your blow-off, or this is called your buying climax. So I'm just going to read it out from this other page while I'm playing on this chart. So buying climax, during which there are often marked increases in volume and price spread. So this is where you get a massive increase in price spread. So I'm sure you guys understand what a spread is. So when you go to buy here, if you were to buy at market, it might eventually buy up here because there's volume, but it's moving so fast that it actually becomes a lack of volume or a lack of liquidity. And that's when you get that big boom, boom, big sharp moves, but then it can also come straight back down just as quickly as soon as there's big selling pressure. And that's pretty much what we saw there. So that was our blow off or our buying climax as the spreads got further and further apart just from lack of interested parties, and we had that big sell off. Now, this could have come down to anywhere. It happened to land here, all right? And this is called our automatic reaction. So this is an automatic reaction to a falling market after a big price rise. So you've got the market moving up. Retailers are like, oh, I want to get in. I need to buy the dip. When's there going to be a dip? Well, we have a dip, and they're happy to buy here, most likely from the consolidation zone from that first sell-off. All right, so automatic reaction, you have a buyer back on here. This is technically called the suckers rally. Okay, this is the market's already told you that there's a top here, and we're about to come back down. But then you have this suckers rally where there's people still buying the market that's technically about to redistribute. So you have that move up here, and then the rally up from that automatic reaction puts in what's called a secondary test. So this could have gone higher, it could have gone up here or up here. It's basically trying to test the high. So this is put in the high, that's our top. Now this secondary test is going to set our trading range. So our trading range bottom right now is the AR, all right, our automatic reaction, which is where we closed and bid up from there. So that was our bottom of the range or the bottom of the trading range. And then our secondary test is going to set the limit to the top of our range. All right, so that was the top of our range there. Failed to make any further high, that was it. So this is where the ideal short is from that suckers rally, okay? Now, depending on how this had have reacted, if this had to come down and not gone any lower than this trading range, and we held support around 10.7 or 10.8, I think it was, and moved up from there, it would have been quite bullish, or it would have at least told us that we're going to potentially consolidate for a little bit longer rather than have a clear idea of direction. But we had this push through to break this trading range, and this is technically it's a test. Now, SOW stands for sign of weakness. Excuse me. And that's telling you that there's a sign of weakness in this support of this trading range. You can see here where it pushed through quite easily. So now that's pretty much already told the big dogs that there's a sign of weakness below this trading range. In other words, there is no buyers down here. Okay, or there is buyers because we got to buy back, but it's telling them that they can push this price quite low, and there's not really a lot of buyers here. So what does that tell them? If they were wanting to push this market higher, they know that they can't fill their bags here because there's not enough volume to buy into. There's not enough selling pressure to buy into. So they need to go a little bit lower. All right. So that's their first test. They're basically testing to see what the buying volume's like down in these lows. So they push it through, create a bit of panic. You get panic sellers. They start buying and go, okay, yep, good strong buyback. We know that there's sellers. We know there's I should say that we know there's sellers down there because they push the price down, but they might want to go a little bit lower than that, and probably looking at this demand zone here. It's only a small demand zone, short-term consolidation, but that's pretty much where we've hit. So instant buyback, this is normally a fairly parabolic move. Now this one didn't go as high, which is a pretty bearish move. UT stands for the up thrust or uptrend. So basically it's supposed to be the impulsive buyback from going low out of the trading range. So as this dips quite low with this sign of weakness, you're supposed to get a strong buyback, a fairly impulsive move, which it was, but it didn't go anywhere near as high as it should have been, which told us there's not a lot of momentum, not a lot of buyers in the market to push us up. So now what you got to think, if you're thinking like a market maker, okay, you're thinking, okay, if I fill my bags here, how high are we going to go? Because there's bugger all buyers in the market. They can't even push us up any higher than this. So what do they think? Okay, if that's as high as we're going, then I don't think we've got enough momentum to push us higher. We have a sell-off and a retest back onto the bottom of this trading range. Doesn't always come down that low, but the fact that it came back to that trading range told us that there's still support there. And then we move up for another test to test what the buyers are like on a breakout. Okay, so most retail traders are breakout traders. They wait for confirmation to give them the idea that, okay, this is confirmed that we are going higher. I'm going to jump back into the market now. And that's the volume that will help push the market up. So that's what they're looking for. So what they do is they try to break tops. So they already know that the trading range or the previous trading range high was set here at that secondary test there. So they need to break that to confirm breakout tradings, which will help push the market up. But if it can't sort of sustain it, then they know that there's not enough buyers there to keep pushing the market up higher, or there's enough sellers there to drive the market down. So we have another test of high, which is an up thrust after distribution. All right, so we've had a little bit of a redistribution. So we've had a sign of weakness pushing low. They've refilled their bags. They've had an up thrust of buying. It hasn't gone too well, so they've distributed again, which means they've basically sold because they tested this and it didn't go. All right, then they have another test after a distribution phase, pushes up, breaks a high. Now they're looking for breakout traders. Not a lot of liquidity then. The volume was slightly increasing, but obviously they weren't happy with it, because if you can go back to here, like that, they were probably looking at the volume thinking, okay, there's not really any buyers there. Sellers already coming into the market, so that's not moving. All right, so they push it back down again. Now the bias is pretty much already set. They know that they can drive it down and get liquidity when they push back down. Excuse me. So you've already given the breakout traders a little bit of confidence by pushing it up high. They drive it back down into another redistribution. And then this move is, again, pretty much a sucker's rally, or to test liquidity in the trading range. This is called last point of supply, LPSY. So SY meaning supply. So last point of supply. So they're just testing to see what else they can get filled here. Another sign of weakness, pushing low, breaking out of that trading range again. And then this last move here, which again is another LPSY, another last attempt to grab some supply. In other words, last attempt to sell their Bitcoin. What this is supposed to do is go into, it technically should have done something like that and not made it back into the trading range. It kind of did, but it hasn't really gone that far into it. But what's supposed to happen here is you're supposed to get quite a tight trading range. So something like, so we've had that move here. We're supposed to have something like this, where price really tightens up into, I guess you would call it a bit of a pennant or a bear flag, something like that. And then the final move is we have that breakout. and that's pretty much the confirmation. So what we're really waiting for here, it's pretty much played out to a T right now, the Wyckoff distribution. We're just waiting for this tight trading range. So I'm not expecting, look, it could happen tonight. We could just eat shit tonight. A few of us are already in this short, ready to let it go. And you got to give it some time, because this move might take a couple of days to play out. So you got to be patient. But there is a bit of a chance that we consolidate like this. What we really want, and this is still a really good confirmation as well, is if this range tightens up, or even, you know, does something like this, if it gets nice and tight in this range and we don't really get any decent price action to the upside, there's a good chance this move's going to play out. And it does kind of line out with higher time frames as well. We'll have a look at them in a second, but yeah, this is pretty much the perfect play for Wyckoff. If it plays out, it's actually an unreal setup. And it kind of pegs us back down around 8,000.